Hey everybody, this is Andrea Jenson from the Cash Flow CFO, and you're listening to the Cash Flow CFO Podcast, the show that explores the financial side of running a business for people who want to maximize profitability and scale with confidence. If you want to make smart financial decisions based on data and put more of your hard-earned profits into your pocket, this is the podcast for you. This episode of the Cash Flow CFO podcast is brought to you by the Cash Flow CFO. Did you know that on average, business owners have up to 84% of their personal net worth tied up in their business? Our virtual CPAs and CFOs, as well as accounting and bookkeeping experts, empower business owners just like you to make big leaps that help them maximize profitability and scale with confidence. Visit thecashflowcfo.com for more information, and thank you for listening. Hey everyone, it's Andrea, and our guest for today is Kirk Michie. Prior to establishing Candor Advisors, did I pronounce that right, Kirk?
You got it.
All right. Kirk spent the last 3 decades worth of experience in financing and capital markets. Over his career, Kirk has raised and allocated over $1 billion in capital while actively participating in over 60 transactions, including buyouts, sales, and other deals, surpassing a total value of $1.5 billion. That is amazing, Kirk. I can't wait to talk to you about that. Kirk brings a wealth of knowledge and expertise in a variety of areas, including transaction advisory services, mergers and acquisitions, with a strong background in both investment and business arenas. Kirk's experience informs his ability to provide invaluable guidance to entrepreneurs as they navigate the intricate decisions concerning their entities, families, and long-term legacies. Welcome to the show, Kirk.
Thanks, Andrea. Appreciate it.
Yeah, thank you. That was a mouthful of a introduction, but I want to acknowledge, wow, it's amazing what you've accomplished in 3 decades, actually. So,
well, thanks. Some of that is just a function of if you've been working for a long time and you are of a certain age, adding decades worth of stuff just kind of rolls through there.
Yep. Well, not everybody has a resume like that. So I think it's very impressive, and I'm excited to chat with you about that.
Thanks.
Yeah. So let's get started. Tell us a little bit about how you ended up in this arena of business and finance and capital markets.
Yeah. So I actually, when I was deciding on college and thinking about what I wanted to do, my general feeling was that every business would be informed by some level of business and business school expertise. So whether you're a dentist or whether you're an investment banker, you're in business, right? And so I chose business as a major. And then when I started getting into upper division courses, in a way, I took path of least resistance. Formulas, ratios, financial calculations, and even a lot of accounting things just came naturally. And so, I just kept riding the horse in the direction it was going, and started out my career as a, retail stockbroker. And, over time, what happened was, rose up within the ranks, ended up running 2 different private client groups, did my first acquisitions as part of business building exercises there, and then, kind of caught the bug. And, after a while, I wanted to be doing only that. And so I went to work in a private equity firm using the skill set I had around fundraising, investor relations, but I became part of the investment committee and got the bug there. And, as a partner there for a bunch of years. And then for a while, I was advising sellers because I don't know how to put this any other way than to say, at a certain point when you're at a private equity firm, you either love being in the position of buying small businesses and, kind of putting them together with other things and then trying to sell them for more money, or you kind of burn out on the idea that you're taking advantage of all these entrepreneurs who've spent decades and decades building these businesses so that you can do financial engineering and try and generate a return for yourself and your investors. At a certain point for me, Andrea, it didn't quite work. And nothing's ever quite as clean or as easy as you can make it sound looking back on it, but that's ultimately what happened. And so I spent 5 years advising sellers on how to get to better outcomes, how to position their businesses better so that they were ready to sell, how they'd get more money, how they needed to think about building a deal team or hiring an investment banker. And then 3.5 years ago, established Candor Advisors. And, what happened is the marketplace was just ready for it. And so, of the numbers you read off, we've been involved in almost $1 billion worth of transactions in the last 2 years. So yes, all of that other stuff prior, the $1.5 billion, that was all accurate too, but nearly $1 billion worth of transactions in just the last 2 years.
Amazing. So I think that it just goes to also talk about, I love how you said the market was right. It was ready for it.
Yeah.
Because that's what's happening right now. There's a tremendous amount of business owners who are, either in the process of getting ready to sell or they're embarking on that journey and they're starting to look at, oh gosh, I need to start putting things in place to be able to do that. That's number one of what you said that I think is really important to point out. And number two, I think I'd love to know a little bit more about, besides going the private equity route, because we know what happens with the private equity, right? It might sound sexy and glamorous in the beginning, but the truth is, they're a business as well, right? They're making a profit. And the way that they do that is sometimes not in the best interest of the seller. What are some of the other options that a business owner who's looking at selling their business, besides like a broker or, things like that they have available to themselves to market their business for sale?
Yeah. Well, there's essentially, kind of three paths, I think. So, the way I think most people think about doing it, regardless of the terms they use, is hiring some financial advisor, financial professional to find the right buyer. And that person goes out and finds the ideal firm. And that firm, throws an offer in. And after some minimal paperwork, they collect a bunch of cash and ride off into the sunset. Now, that's not really the way that it happens. There's like nuances at each point in that journey. But for the first piece of that, the idea is, look, if you're hiring a financial professional, it's either going to be an investment banker who's highly regulated by FINRA and in some cases the SEC also. I'm both. I'm registered. I have 5 different registrations. They're held with a broker-dealer. There's some good reasons to work with only a registered broker-dealer investment banker because there's some rights of rescission that a buyer can use if you're not working through an investment banker. But then there's also the business broker route, which tends to be smaller transactions, can be every bit as professional as the investment banker, but tends to be a little bit less. They in some cases they're not regulated at all by FINRA because FINRA can't regulate you if you don't have licenses. And so let's say the business broker who's working on the sale of a $3 million transaction of a great business that has terrific economics and provides somebody with a wonderful lifestyle, the investment banker is probably not going to touch a transaction at that size. And so they can't do it justice anyway. So there's room for both of those kind of professionals. And like within our network, the Candor Advisors National Network, we have business brokers, we have investment bankers with different skill sets than us. We have people with other subject matter expertise. We even, will refer business to exit planners. We'll send stuff to financial planners where we think there's a bunch of advisors in that mix. And then when it comes to who the buyers are, there's essentially 2 different kinds. There's either strategic buyers, like a company in your same business or in an adjacent business, or financial buyers. And that's those private equity people. And, we can dig further into any of those. There's one way I left out of doing it, and that is to try and sell your company on your own, and there I would just say, that would definitely be, ideal if you could do it. And if you happen to know the right M&A attorney, who could help you navigate it. And if you happen to meet just the right buyer without trying to go out there into the marketplace, create competitive tension and make sure you're getting the highest price, the best terms, and the best control of your legacy going forward, that's unlikely, but it's certainly doable.
I love that. So professionally managed company, you're going to probably go with the investment banker. If you're a owner operator, you're probably going to go with the broker.
Maybe, yeah.
Right? Because that sounds like it would be a little bit more, I think a lot of times the owner operator aren't as buttoned up, right, as a professional. Well, obviously as a professionally managed one, because there's certain levels of, things that are not installed in the business to have it run without the owner. But I think that's important for all the listeners who have a business, who are looking at this going, which way do I go? I think you laid it out very beautifully. So go back and rewind it, guys, and listen to that piece, because that's probably one of the best, plain English explanations that you're going to get without a lot of the other jargon and things like that. So thank you for that.
Thank you.
Yeah. So a lot of our listeners are in that owner operated, area of their business. And they're looking at, I think one of the things that you said at the very end there was to be able to, the terms, control your legacy. What was the other thing that you said? There was 3 of them.
Highest price. Yeah. Highest price, best terms, and legacy control. Right.
Yeah. I think that's what a lot of business owners don't realize either, is that there's a strategy behind all of those things. And there's also ways to protect the legacy and, things like that. So would you mind talking a little bit more about that?
No, not at all. I would say that just, one tiny distinction that whether the business has an enterprise value of 2.5 million and, transferable economics of 250 to 500,000, meaning like, what we would call EBITDA or net income plus add backs, or it's $100 million business. There are dramatic distinctions between how professionalized you might like you would assume that a $100 million company has a CFO and systematized processes and the best possible CRM and ERP system. And, kind of depending on the business they're in, they're, compliant with whatever they need to, and they do the right things on HR. But look, sometimes $100 million businesses are just a couple $1 million businesses that grew really, really fast and they never had to do all that stuff, right? So professionalizing the business to really maximize price, control of terms, and legacy, those things are available whether you're going to sell your company for $500,000 or $500 million, right? Those are worthwhile kind of practices. Now, because I went on such a long tangent, would you repeat your question?
Yes. Well, first, I got a big smile on my face when you were talking about that, because in the position that I'm in and the exposure that I have to so many different businesses, industry, owners, risk tolerance, just all the things, it's been probably one of the most eye-opening experiences is to realize that not all, yes, you're right, not all businesses, no matter the size, have those professionally managed components to it. And it like, at first I was like, how did they possibly get to this big without having these things in place, right? But you just don't know, right? You could just have, in spite of the management, they're going to do well because they're the right market, the right, product, all the different things that just the universe all lined up for them. And it just blows. And still, all of our CFOs will be like, how did they get here without all these things and not go crazy? Because that's the other piece, right? Each one of those that you don't have as you continue to grow and scale your company, it's added stress, because it's just like you're just creating, lack of clarity and lack of systems and all that kind of stuff. But so that's really interesting that you see that too, in all different types of businesses.
I do, Andrea. And the other thing that, I think there's two different kinds of advisors, regardless of whether they're accountants, M&A attorneys, business brokers, investment bankers. There are those who, in recounting stories about, the $5 million business that's super squared away and private equity ready and buttoned down and ready to go through due diligence, or the $50 million company that's a mess and can't, doesn't have any fully executed contracts and, changes accounting methods from one period to the next. The kinds of advisors that love entrepreneurs, and this definitely is us, talk about how wonderful it is that, you can build a business over decades, maybe generations, and not necessarily have to worry too much about that professionalized stuff until you get to an exit, right? And then there are other kinds of advisors that seem critical of entrepreneurs for not being more squared away. And look, the reality is the more squared away they are, the more highly professionalized they are. They need us, but they don't need our advice as much as they need our transactional expertise. And for those that are not yet as professionalized, well, they need us more. They need our transactional expertise too, but they maybe need a little bit more of the, what we call kind of the 3 Gs of being a great advisor. There's guru, guide, and gladiator. So those folks that aren't quite as professionalized, they need more of the guru stuff. We know stuff they don't know. And so it's useful for that, sort of tech transfer to happen between our brains and theirs. The guide piece is like, we've got a lot of experience, a lot of reps in the M&A gym, and we guide them through, like when we've worked with other founders, here's what they've done when they were faced with a retrade from a private equity firm, or finding something in diligence in the legal file that causes the transaction to come to a halt and might derail things entirely. Like, here's how we've guided them through that. Because it's still the founder's journey. It's still their hero's journey, right? To make it to the end. We never become that role, right? So we just keep guiding them. The gladiator piece is interesting. I'm not talking about fighting with the private equity guys who want to retrade, or the lawyer on the other side that wants them to, take some crammed down term that leaves them with a bunch of risk after the deal closes. I'm talking about doing battle with their current self on behalf of their future self that they've outlined for us, that they want to spend more time with their family, or they want to endow their next adventure, or they want to, because what happens in the M&A process is a lot of times, like, diligence gets like invasive and accusatory, and people start to react to it. And part of our role, if we've done a great job in both, kind of the guru and the guide phase, is to be able to be gladiator from time to time and say, hey, listen, Andrea, I know we want the same thing at the end of this transaction, but the way you're reacting to their request for this document, or the way they want to hear more explanation about this incident, is like working against you. So let's like try and kind of fix that. And so we just love entrepreneurs. We just like anybody who, so many times we get outreach from entrepreneurs where they tell us about their business. And I am struck by this kind of, wow, I guess somebody had to get wealthy doing that. I never would have thought of it, right? We just love that part of the work.
Yeah. The riches are in the niches, as they say.
Yeah. Yeah. Well said.
Yeah. No, absolutely. And thank you for that, because I think everybody has this glamorous, they hear stories of, oh, I exited for X number of dollars, but they don't know how many months it took and how much of the emotional journey that is required to get to that point. Start scaling with confidence today. The Cash Flow CFO is a full-service accounting and fractional CFO firm. So it goes without saying that our financial experts are phenomenal at number crunching. But more than that, they are expert communicators who will connect all those complicated financial dots in a way that just makes sense. We don't wait in the wings and check in every so often either. With our boutique approach, we position ourselves front and center, watching over every dollar that comes in and out of your business as if it was our own. So if your business is making money and you're ready to take it to the next level, but you're not sure you completely understand your numbers, and you're looking for that trusted guide to help you build a roadmap to reach your financial goals, it sounds like we would be a great fit. Visit thecashflowcfo.com and let's get started empowering you to build and scale your business the way you want to today.
One question I have for you is, I know we're always looking at EBITDA, right? EBITDA is the thing that will, create the multiple. How much of the story is like, does the story end there? The EBITDA is great. It's in a high multiple industry. Here's, let's move it through. Or is there, the EBITDA is great. It's in a great multiple, but it's not all professionally, it doesn't have everything buttoned up. Tell me a little bit, maybe a story or something that experience that you've had. How much of a factor is all the other stuff if the EBITDA and the multiple is good?
Yeah, it's a fantastic question, because I think the founders, who kind of wonder why the hell this weird accounting acronym becomes so important when they're going to sell. And we'll actually explain it. Other people just trot out well, it means earnings before interest, taxes, depreciation, amortization, and your buyer's going to pay a multiple of that. Or if it's software business, maybe a multiple of ARR, the annual recurring revenue. But so we explained to him that, look, first of all buyers want to know about the transferable economics of the business. They're not buying a piece of commercial real estate, so they can't evaluate the building based upon the rents that it collects and what the average appreciation is in the area. The transferable economics are what comes in at the top and what flows through to the bottom. And the reason they convert that to EBITDA, right? You take the earnings, and then because most deals are cash-free, debt-free, meaning you get to keep the cash on the balance sheet as long as you pay off all the debts, interest is no longer a factor. It's no longer going to be an expense once they own it. So they add back the interest. Now, taxes is trickier, but because they probably are a different entity than you are, meaning when you're selling, you're probably an S Corp or an LLC, they might be a C Corp. So the reason they add back taxes is not that they're not going to pay taxes, but because they need to flow it into their model on a pre-tax basis, because their taxes are going to be different in your business and in general, right? And then the depreciation amortization is, look, whatever property, plant, equipment, whatever assets they're buying are no longer going to be on the depreciation amortization schedules that they are on your books, because they get a step up in basis when that buyer buys the business, whether it's a stock purchase or an asset purchase. So the cleanest way to do that, even though we agree with Charlie Munger when he calls EBITDA BS earnings, is the cleanest way to do that is to come up with that plus the owner add backs, right? Does he run a lease payment through it? Does she charge herself below market, lease rates on the building that she owns? You've got to adjust for the owner economics, and then you get to your adjusted EBITDA, and then you've got a basis for the buyer, right? And then the buyer is going to pay a multiple of EBITDA that's probably market, assuming you're getting good guidance, plus whatever kind of growth rate and blue ocean is ahead of the business, or minus whatever risk factors that are really, really high with the business, like super high customer concentration. Like, you do 20 million a year of revenue and 5 million a year of EBITDA, but 90% of your business comes from Walmart, right? I mean, that's a pretty gnarly customer concentration, right? So you've got to reduce whatever multiple you might pay for that to account for the risk that EBITDA, those transferable economics, won't move over, right? So the things like, unique intellectual property and competitive position and, many of the factors that founders spend a lot of time and take a lot of pride in talking about when they talk about their business, those things matter, and they matter more than incrementally. but they only matter if the transferable economics, the EBITDA, is attractive enough that the buyer, whether they're financial or strategic, is willing to sort of say, oh, well, that would be nice to add. Or since we would trade at a higher multiple than that, we immediately get multiple expansion on that, right? So, unless it checks kind of the EBITDA or revenue box, then the rest of it is not important conversation.
Mm. So well put. Thank you. And I can tell that this is not your first rodeo. You have explained this to many entrepreneurs over the years because, it's digestible and it's actionable. So I hope all of our listeners are taking copious amounts of notes right now because this is really great. So thank you for that. Thank you for sharing your wisdom and your knowledge on all these things.
Thank you.
Yeah. I just think it's so timely because there's, like we said, there's just so many entrepreneurs that my heart breaks to think about them just going, because they could exit planned or they could exit because of an illness. They could exit because of something else and they're not ready. And the years and years and years of building this asset, they don't get the value that they would have gotten had they started this process earlier. So I think it's, so important to get the word out there and 3 to 5 years, people start thinking about this now so that, who knows, somebody might knock on your door because everybody out there is hungry for deals right now. It's just, I don't know if it's just my little world that I hang out in. That's all that is talked about. And, but I think too, the sheer volume, you look at some of the employee retention credit, right? How many Yahoos are calling your phone constantly going, oh, you haven't applied for your thing yet. Oh, yeah. And I'm like, click, delete. This is what's going to happen. I think the market's going to get flooded with people who don't know what they're talking about, who don't have the experience, who can talk a good game, but at the end of the day, don't have the seller's best interest. So, that's why I think it's great to have people like you on.
Well, thank you. I would double click on that, Andrea. I think that we meet other professionals in the sector plenty that, let's say they've got their exit planning designation, but they're really a financial planner and they're just using the exit planning designation to develop more business. I mean, look, we're capitalists. We believe everybody should get their fair share and, we compete and we win most of, what we compete for. So I don't have any problem with any of that. The challenge is when an exit planner goes out there and meets an entrepreneur who has not yet met a business broker or an investment banker who's got lots and lots of transactional expertise. The exit planner can be telling the entrepreneur that they need to focus on certain things because in getting their designation, they found out that those things mattered a lot, and they do, but they might not be the things that cause that entrepreneur to get more money when they sell, or they might not be the things that founder needs to focus on so that they can transfer more of the risk of the business to the buyer. And look, there's $2 trillion worth of dry powder in private equity right now. So that's all that committed uninvested capital. Sellers should, just put the brakes on any private equity firm, financial sponsor, junior associate calling to say, I'm interested in looking at your business and, we're experts in this area and yada, yada, yada. Sellers of great businesses are in the driver's seat here. Multiples have not come down. There's still a ton of capital and a ton of demand from the buy side. There's a guy that we respect who does kind of long-term private equity investments. He's out in the Midwest. He's hosting a business buyer summit either this week or next week. And I looked at the site, and first of all, he's terrific. He's wonderful. And if every small business buyer were like this guy, we would have never come up with the phrase that the buyer of your business is a full-time predator and you as the seller are a part-time prey. We never would have come up with that if they were all like this guy. But most of them are not. And there are more than 1,000 people going to his little town in the Midwest for this buyer summit because the buyers are amassing capital and deal structure expertise. And the sellers are busy running their injection molding business, knocking out 10 million a year revenue and $1.5 million to $2.5 million of EBITDA. And they're not ready for that, right? And so if they get to us first, then they can get ready. They can armor up against that full-time predator. But if they don't, then they're actually going to believe that this private equity firm is founder friendly and long-term patient capital. And no, we want to grow with you. We actually want that second bite of the apple to be more meaningful. That's why we're asking you to, go for this 40% of purchase price earnout based on EBITDA that you'll no longer control, right? Those buyers are out there and they're not bad people. And these predatory tactics are not because they really want to rip people off. It's just that, look, if you've decided you want to buy businesses in a sector or you've located a specific business, it's a little bit like, when you decide on a car you want. You do not walk onto the lot and say, so I want to make sure that I pay you top price for this car because I really, really want it, but I want to make sure you and your family are well taken care of. Look, that's just not the way we buy things. As soon as we decide we want to buy something, we look for how little can we put down or how little can we pay, right? And so the buyer of your business is no different than that.
100%. 100%. Thank you. You're amazing. Yes. I love talking to people, that have that same, the same beliefs and the same take care of people and, do what's right. And there are so many opportunities out there that are win-win, right? And so it really, each individual, their goals and what they're trying to achieve with their business, their asset. I always tell people, I'm like, your business is an asset. And they kind of look at me like, huh? I'm like, it's an asset. Do you know that you're working on an asset? And they're like, oh, okay. So it takes a little while for them to get that thought process ingrained in them. But once you do, you completely, do business differently because everything is, how am I making my asset worth more money? Future value and things like that. But I think that it's, there's a buyer for everybody. There's a deal for everybody. And there's not one size fits all. And you need to, do your homework and
absolutely
and find the right one.
Yeah, absolutely.
Awesome. This has been such a great conversation. I wish I had, I could sit all day long and talk shop with you because it's so great and refreshing. But we do have to wrap up. Before I do though, is there anything that I didn't ask you that you think is valuable that our listeners walk away with that information?
Yeah, I would say, and I'll try and go really quickly, there are 6 secrets in common for every successful sale that we've been involved in and those that we've watched or are aware of. So the first one is the seller needs to know their why. I mean, do you want to completely retire? You're so sick of this thing, you can't imagine yourself doing it for 6 more months, much less 6 more years. Do you want to endow your next adventure or are you endowing the rest of your life so that net of, inflation, expenses and taxes, you can never run out of money, right? So get clear on the why. Why are you selling the business? Because then the second secret is the right buyer matches not just price and terms, but why, right? Those things have to match up. If you want to take all cash and ride off into the sunset, then a private equity buyer is not the right buyer for you because they're going to want you to stay around. They're going to probably structure it so that they're counting on you being involved in the business. The third thing is professionalize your financials. Cannot emphasize that enough because the transferable economics of the business are how it will be valued. Do not send them a QuickBooks download and assume that they're going to give you the benefit of the doubt when you find out later that you needed to adjust it. So professionalize those financials before you engage in those discussions. Don't give up too much too soon. Make sure there's an NDA in place if somebody wants information, and don't share anything more than you absolutely have to. A few years worth of financials is plenty for them to give you an indication of interest. And then don't try and do it on your own. Even if you don't hire a business broker or an M&A lawyer or an investment banker, at least go out to your EO, Vistage, YPO, or other business networking group and get the experiences of other people who've been through it before. Make sure you benefit from their scar tissue. And lastly, the number one deal killer is seller expectations. So what I mean by that is not that you love your business so much you won't let it go for, whatever. It's like, make sure you understand how the business, the market values your business. If that's not high enough for you to be able to walk away, look at alternative strategies, whether it be a full or partial ESOP and the tax benefits that might come to you from that, a seller financed internal deal, developing a successor and becoming a limited partnership in your own business, but accept whatever the market says your business is worth and either grow it to a higher number so that you get the market value and you can ride off into the sunset, or explore a different transaction, but don't argue with the market. It's a waste of your time, it's a waste of the market's time, and you're both going to get frustrated. So, sorry, that was long-winded, but that's the takeaway.
Beautiful. That's awesome. Thank you so much for sharing all of your gems of information. And for all the buyers out there who want to learn more about your services, how can they reach out and contact you?
So it's Candor, Candor -advisors.com. There's an insight section on our website. It's a tab at the top. There are more than 100 videos of me explaining different things about the buyout process. And then we've also just launched another business called EBITDA, EBITDA, university.com, where we teach classes to founders. So we're not necessarily trying to get them over to Candor Advisors or anybody else. We're just trying to make sure that if they want to do it on their own, or if they want to learn more in that 3 to 5 year period you so eloquently suggested, that this is a great place to start. There's a free version, there's a pretty inexpensive version, and a moderately priced version where they can kind of go through this. So either one of those sites.
Awesome. That is so great. Thank you. And we'll have links to all of that in the show notes. So thank you so much for your time today. This has been probably one of my favorite conversations. So thank you for that.
Thank you, Andrea. It was great being with you.
Thank you for listening. Don't forget to like and review, and we'll catch you on the next episode. If you're looking for more content or resources in the meantime, check out our website for information, blogs, and our I've Got a Spreadsheet for That series. That's thecashflowcfo.com. Again, thecashflowcfo.com. We can't wait to hear from you.